Hello everyone, myself Ganesh Gaikwad. In this video, I am going to introduce you to a new chapter called Marginal Costing. So let's begin. So, in this topic, we'll understand the meaning of absorption costing and marginal costing, meaning of marginal cost with examples, the difference between absorption costing and marginal costing, and the advantages of marginal costing. So there are mainly two techniques of product costing and income determination. So first one absorption costing and second one marginal costing. We'll start with absorption costing. Absorption costing, it is also known as traditional costing, conventional costing and full costing. The meaning of absorption costing. This is a total cost technique under which total cost, that is fixed cost as well as variable cost, is charged as a production cost. In other words, the absorption costing, all manufacturing costs are absorbed in the cost of the product produced. In this system, the factory overheads are absorbed on the basis of a predetermined overhead rates based on normal capacity. Absorption costing approach is same as using cost sheet. Next one, marginal costing. An alternative to absorption costing is marginal costing or variable costing or direct costing. Under this technique, only variable costs are charged as a product cost and included in inventory valuation. Fixed manufacturing costs are not allotted to product but are considered as a directly to profit and loss account of that year. Fixed costs also do not enter in stock valuation. Both absorption costing and marginal costing treat non-manufacturing cost, that is administration, selling and distribution overheads, as a period cost. Next, meaning of marginal cost. Marginal cost is the additional cost of producing an additional unit of a product. It is the total of all variable cost. It is composed of all direct cost and variable overheads. An important point is that marginal cost per unit remain unchanged irrespective of the level of the activity. For example, a company manufactures 100 units of a product per month. Total fixed cost per month is rupees 5,000 and marginal cost per unit is rupees 250. The total cost per month will be. We have to calculate total cost per month. So marginal cost of 100 units is rupees 25,000. Fixed cost is given 5,000. So 25,000 plus 5,000. Then you will get the total cost rupees 30,000. If output is increased by 1 unit, the cost will appear as follows. Marginal cost is rupees 25,250. Fixed cost is given 5,000. So 25,250 plus 5,000. Then you will get the total cost rupees 30,250. Thus the additional cost of producing one additional unit is rupees 250, which is its marginal cost. However, where fixed cost may also increase with the increase in the volume of output, but this may be the result of increase in production capacity. Such increase in fixed cost are dealt with as a part of what is known as a differential cost analysis discussed in chapter on decision making. Next, difference between absorption costing and marginal costing. First one, treatment of fixed and variable cost. In marginal costing, only variable costs are charged to products. Fixed costs are treated as a period cost and charged to profit and loss account of the period. In absorption costing, all costs, both fixed and variable, are charged to the product. The fixed factory overhead cost is absorption in units produced at a rate predetermined. Next one, valuation of stock. In marginal costing, stock of WIP and finished goods are valued at marginal cost only. In absorption costing, stocks are valued at total cost, which includes both fixed and variable cost. Thus, stock valuation in marginal costing is lower than that in absorption costing. Next, measurement of profitability. In marginal costing, relative profitability of product or department is based on a study of relative contribution made by respective product or departments. The managerial decision is guided by contribution. In absorption costing, relative profitability is judged by profit figure, which is also a guiding factor for managerial decision. Next, income determination under marginal costing and absorption costing. The first one, the net profit under the two systems may be the same or may be different. Difference in profit may be because of the difference basis of inventory valuation. In marginal costing, stock of WIP and finished goods are valued at variable cost. In absorption costing, stocks are valued at total cost. Next, advantages of marginal costing. And the first one, pricing. Pricing decision based on marginal cost are simple, as fixed costs are excluded. If fixed cost is included for pricing, the unit cost will change from day to day depending upon the volume of output. This will make pricing decision difficult. Second one, overhead recovery. Fixed overheads are recovered in absorption costing on the basis of predetermined rates. If fixed overheads are included on the basis of predetermined rates, there will be under recovery of overheads if production is less or if overheads are more. Marginal costing avoids such under or over recovery of fixed overheads. Third one, operations. Marginal costing system is simple to operate than absorption costing because it does not involve the problems of overheads apportionment and recovery. Fourth one, realistic profit. Under the marginal costing technique, marginal costs are treated as product cost and fixed costs are treated as fixed cost. Hence, the stock of finished goods and work in progress are carried at marginal cost and fixed expenses are written off to profit and loss account. Thus, this shows the true profit of the product and the period. Fifth one, production volume. Marginal costing helps in production planning with the preparation of break-even analysis, which shows the effect of increasing or decreasing production activity on the profitability of the company. Next point, control over expenditure. Segregation of expenses as fixed and variable helps the management to exercise control over expenditure. The management can compare the actual variable expenses with the budget variable expenses and take corrective action through analysis of variance. Seventh one, short-term profit planning. It helps in short-term profit planning by BEP charts. The contribution ratio and the marginal cost ratio are very useful to ascertain the changes in selling price, variable cost, etc. Second last, performance evaluation. When a business concern consists of several units and produce several products, and evaluation of performance of such components can well be made with the help of marginal costing. And the last one, managerial decision. It is easier to make decision on the basis of marginal cost presentations. I am sure this video has helped to understand the concept of marginal costing and absorption costing. If you have any doubt, then you can mail me on given email ID. Thank you so much.